Welcome to vTalkInsight, Risk Sentiment Daily for February 17th, 2026. AI volatility, inflation crosscurrents, and a powerful shift toward emerging markets and Europe are pulling risk appetite in different directions today. Let's unpack how a cautious risk-on tone is emerging beneath elevated uncertainty. Across today's tape, overall risk sentiment looks cautiously risk-on rather than outright defensive. Risk assets are finding support from softer U.S. inflation data, firm earnings, and strong demand for both emerging market equities and credit. At the same time, volatility remains elevated as investors wrestle with AI disruption, lingering inflation risks, and a noisy geopolitical backdrop, leaving positioning selective rather than all-in. Recent disinflation surprises in the U.S. have boosted both equities and bonds, while falling gold prices suggest some unwinding of classic safe haven positions. Credit markets remain robust, with high-quality issuance absorbed easily and strong inflows into European fixed income and local currency emerging market debt. Yet equity leadership is rotating aggressively. Capital is moving away from U.S. megacap tech and AI names toward European banks, industrials, and Asia ex-Japan, reflecting a desire to stay invested in growth while dialing down concentration and AI-specific risk. Compared with last week's more defensive tone, when tech-led drawdowns and CPI nerves dominated, today's backdrop feels more balanced. Soft landing narratives, expectations for eventual Fed easing, and strong earnings in key regions are acting as stabilizers. However, the absence of a clear single catalyst, thin liquidity around holiday-affected sessions, and upcoming macro releases mean conviction is still limited. The result is a cautious risk-on stance, with investors leaning into selective opportunities, but keeping an eye on downside scenarios. Soft landing and Fed easing hopes remain a key bullish driver for risk assets. Recent U.S. inflation readings have been described as close to a Goldilocks outcome, with price pressures seen as manageable and growth still resilient. Better-than-expected inflation data has lifted both equities and bonds, reinforcing the idea that the economy can slow gently without tipping into a deep downturn, and that policy can gradually pivot toward easier settings. Market pricing currently embeds around 2 Federal Reserve rate cuts, while some see risks skewed toward an even more dovish outcome if growth or inflation data underperforms. Cooling wage growth and subdued hiring indicators reduce the risk of a wage-driven inflation flare-up, strengthening the case for fixed income as a portfolio hedge. Local currency emerging market debt is drawing the strongest inflows among fixed income segments, and European bonds offer near-decade-high real yields, suggesting investors are comfortable extending duration selectively where they see credible disinflation and policy support. The counterpoint is that underlying U.S. inflation is still above target, with core measures hovering around the low to mid 3% area, and some components like gasoline and chip costs could re-accelerate. In a scenario where the Fed cuts aggressively while growth stays strong and fiscal deficits remain around 7 to 8% of GDP, long-dated Treasury yields could spike toward 5%. That risk of a yield shock limits how far investors are willing to chase duration today. Upcoming U.S. jobs data, UK inflation figures, and Fed minutes are therefore pivotal signposts. For now, though, the soft landing and gradual easing narrative is giving markets a policy cushion that encourages a measured, rather than fearful, approach to risk. Rotation toward emerging markets and European assets is another important bullish driver. After a period of U.S. megacap tech dominance, investors are increasingly diversifying away from concentrated AI exposures and dollar risk. Flows show emerging market equities attracting their fastest inflows since 2019, helped by both diversification motives and structural themes such as AI infrastructure and a softer dollar environment. Asia ex-Japan stands out, with around 30% of companies linked to AI themes and valuations seen as more attractive than in the US or Europe. Korea is highlighted for government efforts to boost valuations and its strong defense and AI-related sectors, supporting expectations of continued outperformance. India is another focal point, with earnings growth estimated around 15% this year, supported by domestic consumption, easing inflation, and lower rates. Its more domestically driven cycle offers diversification from the global AI trade and U.S. market swings. Europe is also drawing interest as an alternative to U.S. tech-heavy benchmarks. The region's lack of a dominant IT sector, combined with strong financials and industrials, reduces perceived AI disruption risk, while European banks are outperforming with gains of more than 1% in recent trade. Additional support comes from increased European infrastructure and defense spending, as well as attractive real yields in European fixed income. The main risk to this rotation is that lingering geopolitical tensions and directionless near-term trading could spark setbacks, but for now, the shift toward EM and Europe is a clear undercurrent in global positioning. AI capex boosting cyclicals and earnings is the third major bullish pillar. Hyperscale technology platforms are expected to invest more than $600 billion in capital expenditure this year, much of it directed toward data centers, power infrastructure, and networking. Industrial sectors in both the U.S. and Europe are seen as prime beneficiaries, supported by robust manufacturing data and strong order backlogs tied to AI-related build-outs. Despite turbulence in technology stocks, corporate earnings remain a source of resilience. Across the S&P 500, strong double-digit earnings growth is underpinning expectations for new all-time highs by year-end, even as leadership within the index continues to shift. AI-linked corporate issuance in credit markets is sizable and well-absorbed, indicating that lenders still view these investment programs as fundamentally supportive of long-term profitability, rather than purely speculative. The key caveat is execution risk. Not all AI spending will translate into investor returns, and some management teams remain unsure how new technologies will reshape their business models, as evidenced by the tone of recent earnings calls. Nonetheless, the combination of large-scale AI infrastructure investment, solid industrial demand, and broad-based earnings growth provides an important counterweight to the pockets of volatility elsewhere in the equity complex. It keeps the cyclical growth story alive even as markets question specific AI equity winners. On the bearish side, AI uncertainty and tech supply shocks are front and center. Rapid AI adoption is making it hard for investors to value technology and software franchises, with both upside from efficiency gains and downside from potential obsolescence. This uncertainty is fueling volatility, particularly in software and high-valuation names, and has contributed to recent underperformance in U.S. large-cap tech, even as AI headlines remain overwhelmingly positive. At the same time, the hardware side of AI is running into serious bottlenecks. Surging demand for advanced AI chips has created a severe memory chip shortage, with supply unable to keep pace because new fabrication plants take years to build. Estimates suggest some memory prices, such as DRAM, could rise around 60% quarter-on-quarter. Major technology companies, including smartphone and device manufacturers, are warning about margin pressure and potential delays to product launches. These supply shocks have two key implications. First, they risk reigniting inflationary pressure through higher tech hardware and related commodity costs, complicating the macro picture just as markets lean into a disinflation narrative. Second, they fuel a rotation toward sectors seen as less exposed to AI disruption, including more capital-intensive, traditional industries, and encourage investors to use the front end of the U.S. yield curve as a hedge against both AI-driven labor displacement and the risk of overinvestment. AI remains a powerful growth story, but the path for tech-heavy equity baskets looks bumpier than the thematic headlines suggest. Underlying inflation and yield shock risks form another major headwind. While headline data have moderated, core measures of U.S. inflation, such as PCE and CPI, are still running above the Federal Reserve's 2% target. There are concerns that components like gasoline and AI-related chip costs could push price pressures higher again in coming months, particularly if growth remains reasonably firm. One prominent risk scenario is that the Fed cuts rates aggressively even as growth holds up and fiscal deficits stay large, around 7 to 8% of GDP. In that environment, Markets fear long-term Treasury yields could spike toward 5% as investors demand compensation for inflation and heavy supply. Such a yield shock would challenge long-duration assets, from growth equities to traditional safe haven government bonds, and helps explain why some investors prefer high-quality corporate credit and European fixed income over U.S. duration risk. Labor market signals add nuance. Unemployment remains low and recent data suggest ongoing economic strength, but net job creation in 2023 was weak by historical standards outside recessions, highlighting underlying fragility. This mixed backdrop keeps the Fed's policy path uncertain. Too slow a cutting cycle risks tightening financial conditions via higher real yields, while too fast raises the specter of a duration scare. For now, these inflation and yield risks act as a ceiling on how bullish markets are willing to become. Geopolitics and hidden financial fragilities round out the bearish drivers. The war in Ukraine continues with severe human and infrastructure losses and no clear path to military victory, keeping European risk premiums elevated. Uncertainty around future U.S. support, questions over the reliability of U.S. security commitments, and growing doubts about the durability of the Western-led rules-based order are all feeding a more cautious stance toward European assets, even as fiscal spending on defense and infrastructure rises. Beyond Europe, geopolitical flashpoints stretch from indirect U.S.-Iran nuclear talks to ongoing tensions in the Middle East and the complex relationship between the U.S. and China. Western policymakers are increasingly focused on reducing reliance on foreign-controlled supply chains, particularly those centered on China, which adds to deglobalization pressures and potential cost increases. While diplomatic engagement continues, it is seen more as a risk management tool than a sign of strategic convergence, implying that geopolitical risk is likely to remain a persistent, rather than transient, feature of the landscape. Overlaying this is concern about hidden vulnerabilities in the financial system, especially in private credit and non-bank financial institutions. Regulators have limited visibility into these areas, despite an estimated $2.2 trillion of lending and commitments between banks and non-banks in the U.S. alone. With political momentum favoring deregulation and reliance on voluntary data disclosure, there is a risk that stress in private markets could interact with geopolitical or macro shocks in unpredictable ways. That uncertainty encourages investors to maintain diversification and liquidity buffers, even as they lean selectively into the prevailing risk-on opportunities. To sum up, today's backdrop is cautiously risk-on. Softer inflation prints, expectations for eventual Fed easing, and strong earnings and flows into emerging markets and Europe are providing a meaningful cushion for risk assets. Against that, AI uncertainty, tech supply bottlenecks, underlying inflation and yield shock risks, and a fraught geopolitical and private credit environment keep volatility elevated and argue for selective, rather than indiscriminate, risk-taking. Watch upcoming labor and inflation data, AI-related supply chain signals, and geopolitical developments for clues on whether this delicate balance tilts toward a more durable risk-on phase or a renewed risk-off episode. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.